uh, take this conversation forward. We do have with us Arul Selvan, who's the CFO of Cholamandalam Investment and Finance. Joining in our discussion, we focus on vehicle finance, truck replacement cycle, RBI policy, funding, costs and rate outlook, but more importantly, geopolitical risks, all these, how that impacts the demand. Let's start with the RBI policy, funding costs and the interest rate outlook itself first. The measurements, the measures announced by the RBI with regards to the currency, I'm not sure if that directly impacts you, but would you be interested in raising funds via external commercial borrowings now that the RBI has made it a lot easier for you? And what's your view on rates and demand at large?
See, it has always been our endeavor to keep matching what is the domestic pricing vis-a-vis the landed cost of a ECB on a fully hedged basis. If this turns out to be good, then we do capitalize on that, as you would have seen with what we did in the previous years, where we even crossed the automatic threshold limit and went for further approvals with RBI. Right now, the landed cost is still higher, especially in the context of considering the withholding tax, etc. So we are very selective in looking at ECPs only through GIFT City entities, etc. So we are selective. We have around 6% of our borrowings coming through ECPs. We'll keep watching this and taking advantage of that. Right now, I don't see that too much of an opportunity there.
6% of your current borrowings are from ECBs. The circular was released yesterday as well. You've gone through that, I presume, and would you consider raising it? Right now, you said no, but maybe at some point?
Yes, as I said, we keep constantly measuring what is the domestic price. Domestic price has also come off. As you would have seen, there has been a reduction post the policy in the domestic prices. So to that extent, we keep comparing and we have certain approvals ready for ECB availments. But right now, the landed cost still seems to be higher than the domestic. So we are on a wait and watch mode on ECBs.
Okay, all right. Hi, Mr. Selvan. Always good to have you, sir, on the show. I think you're guiding for overall AUM growth of around 20-23%. That's on, right? I mean, are you confident you could get to that number? And also wanted to understand, how does the book evolve from now on? Vehicle finance is the largest part of the mix. But mortgage, which is LAP as well as home loans, that as well has been growing well. And new business over the last few years has moved up substantially. So how do you see the mix evolve in the coming years?
So, vehicle finance has its own growth target. It will certainly grow, maybe a shade less than the 20% number, yes. Being a larger book. And over cycle, this will reduce as part of the portfolio from today 53%, what is a vehicle finance. It has been coming down from almost 78%, let's say 3-4 years back to now 53%. And it will come down sub 50% as we move into the next few years. Mortgage will become a larger portfolio. Two reasons: they are growing faster and they also stay on the book for a longer period because the tenor of these loans are larger. So they will become around 40%, and the rest of the businesses would be the balance, which we will be growing cautiously. But as a percentage of growth, they will look larger because the base is small.
Right. All right. The other measure that came in with regard to vehicles itself is, that change that we heard about in North India. So my question to you is, could you share what is the current regional mix of a vehicle finance book? Could you tell us what is North India's contribution and whether or not, that NCR vehicle replacement scheme that was announced, will it accelerate North India's share, the incremental disbursements, say, in the next few years?
See, at a very broad level, overall, the North has got around 20-21% of the overall book in the vehicle finance. But the application of this scheme is only in the NCR, which is part of the North, but not all of the North. So to that extent, it will be little lower impact for us. More so, the impact would be larger with heavy commercial vehicle, where our role is lesser because we are not a fleet funding entity. We are more a SRTO funding entity. So our customer profile is slightly lower with regard to the fleet operator. So to that extent, these benefits may not necessarily be to our customer profile. but we will see how it can be benefited. The benefits is not only at the time of purchase, while there are some discounts being offered by select AUMs, but it is also over the cycle with regard to fuel price reduction, etc. So we'll have to see how this pans out.
All right, since you spoke about fuel prices, just with the rise in fuel prices, do you feel there could be some stress on repayment?
See, the fuel price increase by itself will not impact any of the fleet of any of the vehicle operators. Primarily, they will pass it on, maybe with some lag. But the more critical factor is the availability of material to transport. If there is availability of material to transport, this fuel price increase will get passed on, and as a percentage of the material cost that is being transported, the increase would be marginal and it will get absorbed. It will have some lag effect. I don't deny that, but certainly this is what is the assumption, and that is what we have seen practically happening in the past when fuel prices went up. But the important thing is there should be material to transport, which is like the lack of LPG, lack of other factors should not reduce demand for transportation. If that is not there, then there will be no large impact on account of the fuel price increase.
I mean, that is a hypothetical situation, right? I just wanted to understand, are you currently worried about repayments coming in?
No, not. As of now, we are whatever our experience in April and May has been fairly good, and we expect the first quarter to be fairly good. But we need to wait and watch on how the transportation issues that is affecting the Strait of Hormuz will impact certain key products to be imported through that route, and that how it will impact a certain production and availability of material in the domestic arena.
All right, Mr. Selvan, now that banks can raise finances more cheaply via the foreign deposits as well as borrowings, this as was noted in the recent RBI policy meet, will you be pressured to drop rates? Do you see it as a bit of some pressure on you because they could source funds cheaper?
Primarily, banks and we were not on a competing foot, especially with regard to vehicle finance. So they had been more concentrating on fleets, and we have more on the SRTOs. So I really don't see them competing in our arena. Our competition lies with captives and certain banks. Maybe I agree, like IndusInd, etc. But we have been facing them over longer period cycles, and we have not felt any adverse impact on account of that. The banks which could leverage the new development on the announcement are those which are certainly not in our competition radar.
Got that. Mr. Selvan, thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV18. Well, the